Abbiamo di fronte un anno ricco di variabili politiche e macroeconomiche che influenzeranno l'andamento dei mercati, creando uno scenario di incertezza tra i risparmiatori. L'industria del risparmio gestito ha di fronte a sé una grande sfida: continuare a generare valore per ripagare la fiducia dei risparmiatori e offrire prodotti e servizi adeguati alle esigenze della clientela. Al Salone del Risparmio gli operatori possono valorizzare il proprio know-how, instaurare nuove collaborazioni e aggiornare i propri stakeholder. Scopri tutte le conferenze del percorso P6 dedicato ai portafogli su misura, mercati e servizi finanziari.
Buongiorno a tutti, sono Lorenzo Alfieri, responsabile in Italia di JP Morgan Asset Management. Innanzitutto grazie di essere qui con noi. Quest'anno abbiamo deciso di fare ovviamente una conferenza, come il titolo abbastanza esplicitamente ce lo dice, su un evento che abbiamo ritenuto sin dall'inizio abbastanza disruptive, come dicono gli anglosassoni, cioè un evento imprevedibile che ha cambiato molte dinamiche dei mercati finanziari. Ora, forse parlare di Trumpismo i primi 100 giorni è un po' antiquato, infatti cercheremo di parlare sia dei primi 100 giorni ma soprattutto di quello che accadrà nei prossimi giorni o nei prossimi mesi. Credo che sia molto più interessante per noi e per i mercati finanziari. Per questo motivo abbiamo chiamato da New York Dr. David Kelly, che è il capo globale delle strategie di investimento di JP Morgan Asset Management, che ci esporrà ovviamente la sua visione di questo importantissimo, interessantissimo periodo dagli Stati Uniti e per gli Stati Uniti e non solo. Abbiamo pensato però di fare una cosa interessante anche per voi. David Kelly alla fine della sua presentazione, che durerà 35-40 minuti, è aperto alle domande, quindi tenetevi pronti. Se avete delle domande passeremo tra le fila per raccogliere e chiedere direttamente a lui ulteriori informazioni se ci saranno. Quindi vi lascio alla conferenza, grazie mille ancora della vostra partecipazione e buon lavoro.
Thank you. Thank you, Lorenzo, and thank you all for having me at your conference. So my speech is entitled 100 Days of Trump. We're at day 85 right now. It certainly is important. It's affecting global markets. The Trump presidency is affecting attitudes And so I think it is important to try to give you some perspective on what I think it means for investors. Before I get started, though, I want to make 2 points. First, there is no middle ground when it comes to Donald Trump. People love him or people hate him. There is nobody in the middle. It is not my job to give political advice. So I'm just going to talk about his policies, not his personality. The second thing I want to say is I'm not even going to talk about all his policies. Obviously, there are very strong emotional issues with regard to immigration or abortion rights or social issues or even foreign policy issues. I won't talk about those unless they impact his popularity and that impacts his ability to move in his agenda. But having said that, there are a few things I do want to talk about. In particular, I want to talk about the economy that he's inheriting. The American economy, I think it is so important for people to understand, is basically a healthy tortoise, not a sickly hare. It is not capable of growing at 3% or 4%. It is perfectly capable of ambling forward at 2% per year. It's in good shape, but that affects how Mr. Trump's policies would impact the economy. The second thing I want to do is talk about the proposals that Mr. Trump has, particularly now that the Republicans control the White House and the House of Representatives and the Senate. These proposals now become important. But I want to talk also about the very important obstacles he faces. He faces political obstacles. He faces budgetary obstacles. He faces economic obstacles. And this is very important. This is a big agenda, but I think in the end we will see small change because of these obstacles. Third thing, I particularly want to talk about trade and tariffs because it is important to an international audience. Again, the basic message is a loud bark, a small bite. I don't think he will have as much impact on trade or tariffs as people fear. Fourth thing, I want to talk about the political ramifications of the populist leaders here and in the United States and around Europe and how this populist revolution could affect things. I think it's important again to be realistic about what could happen here and not just be fearful that what happened last year with Brexit or with Donald Trump means populist instability here in Europe. And then finally, because most of what I'm talking about affects the US economy and US markets, I do want to talk about the opportunities that I think exist today within the US economy and US markets. This has been a long expansion in the United States. The opportunity from here is not as good as it has been to this point. But we still think there are opportunities for European investors to invest in the United States. It just requires a more thoughtful approach, looking at which stocks and which areas of fixed income and which alternatives to look at. So I'd like to talk about those things, and then I want to open it up to all of you for any questions. So please think up of some questions, and I'll try to answer them at the end. But let me start with my healthy tortoise. When you look at the US economy, we are using charts from our guide to the markets. I hope you get our European guide to the markets. If you don't, please talk to somebody at JP Morgan. But one of the charts we have in the US guide to the markets looks at the length and strength of the current economic expansion in the US. Good news, bad news. The good news is that this is now in the US the third longest expansion since the year 1900. What this chart shows in months is the length of expansions and recessions since 1900. A few things you can see. First of all, the gray bars are the length of expansions, the blue bars the length of recessions. The first thing investors need to know is this is mostly an economy of long summers and short winters. We have longer expansions than recessions. Second, there has been a period of global economic warming. The expansions are actually getting longer over time. Despite the volatility of the 2000s, these expansions are getting longer. And this one, as I said, is now, in June, it will go into its 9th year. That's the good news. The bad news is this. This shows economic activity or GDP from the peak of the prior business cycle into the recession and into the recovery. You don't need to look too closely to figure out which post-war expansion we are in right now. It's that light blue one at the bottom. It's been extraordinarily slow. Now, after 8 years, it has actually achieved a lot, but it's been a very slow process. Let me talk a little bit about the short run. In the short run, we have seen a change in attitudes in the US. Consumer confidence has gone up, business confidence has gone up. We haven't seen a change in economic growth. Since the start of the expansion, we have averaged 2.1% growth. That's exactly what we're doing now. We did 2.1% growth in the fourth quarter. In the first quarter of this year, we'll get the numbers in 2 weeks. In the first quarter, we think we did about 1.5% to 2% growth. If we get sort of Trump minor, not Trump major, but Trump minor, if we get a small amount of fiscal stimulus, I expect growth to be 2 to 2.5% this year, maybe 2.5% to 3% next year. So some pickup in growth, but nothing huge. The second thing is we expect unemployment to fall further. In the course of this expansion, the unemployment rate in the United States has gone from 10% in October of 2009 all the way down to 4.5%, 4.5% in March. If we get 2 to 2.5% growth this year, 2.5% to 3% growth next year, we think we will hit 4% by the end of this year and be below 3.5% by the end of next year. And that is, by any definition, full employment. I think we are already actually at full employment. We can still push it down further. It will cost higher wages. It will push up inflation a bit. But with a little bit of stimulus, I think that's where we're going. But the key point is, we are out of workers in the United States. And that will slow growth. And by the way, I think there's, and I'll get to this, there is a supply side problem, but there's also a demand problem. If you look at US GDP, the pieces, net exports, trade, that's actually getting worse because the dollar is too high. If you look at home building, we are already basically back to pre-recession levels. If you look at vehicle sales, we're above pre-recession levels. This is a geriatric expansion. It's very old. There is no pent-up demand left. And so I believe the US economy would normally grow 2% over the next 2 years. If we get some stimulus, 2 to 2.5, 2.5 to 3, but that's it. How about inflation? This chart here shows the inflation rate in the United States going back over the last 50 years. The CPI, Consumer Price Index inflation rate. The light blue line is the overall inflation rate, and it bounces up or down because of energy prices. The gray line is the core CPI. In February, the overall inflation rate was 2.8% year over year. The core CPI rate was 2.2% year over year. But those are not the important numbers on this page. The most important number is the personal consumption deflator, the headline personal consumption deflator, which in February was up 2.1% year over year. Why is that the most important? Because that's what the Federal Reserve follows. For years, the Federal Reserve has said, we want inflation to get back towards 2%. Guess what? They're there. And in fact, if you look at all the things the Federal Reserve wanted to achieve, they should be breaking open the champagne. Because these forecasts here, this is from their March meeting. Look where, in this little table, look where they think the economy should be in the long run. In the long run, they think we should be at 1.8% growth. Well, we did 2.1% growth. Check, we're there. In the long run, they think the unemployment rate should be 4.7%. We are already at 4.5. Check, we're there. In the long run, they think the inflation rate, as measured by the personal consumption deflator, should be 2%. We're at 2.1%. Check, we're there. In fact, on this page, the only thing that is completely out of balance or out of whack here, the only thing that's out of balance is the federal funds rate. They think in the long run, the federal funds rate should be 3%, and yet today we are between 75 and 100 basis points. And that is why we expect the Federal Reserve to tighten, because they have achieved all their long-term goals. They have no further excuse. In addition, they need to rearm themselves. They need to reload themselves. The thing they are scared of is, at some stage, we will have a recession. And when you have a recession, the Federal Reserve will want to respond with significant rate cuts. But you cannot have significant rate cuts if you don't have significant rates. And so we believe our baseline forecast is the Federal Reserve. The Federal Reserve has 8 meetings during a year, 8 meetings. But 4 of those, Janet Yellen has a press conference, the other 4 she doesn't. We think they will raise rates by 25 basis points at every press conference meeting over the next 2 years when there isn't a crisis. And that's a big if. The Federal Reserve are a little bit like scared kittens. Anything scares them. And so it doesn't take much to be a crisis for the Federal Reserve. But if there is no crisis, we think we get 4 rate hikes this year, 4 rate hikes next year. In addition, they have said in their minutes that they will begin to reduce their balance sheet, or they will announce plans to reduce their balance sheet later this year. Our baseline forecast is that they do announce that in December. Starting in January, they would cut their balance sheet by a little amount, $10 billion per year, or per month. So $10 billion per month just to get started. But overall, we do think this is a healthy economy. The Federal Reserve needs to get monetary policy back to normal. So, Mr. Trump has inherited, he looks very excited. I don't know if that's happy, but he looks excited. But he should be happy with the economy. But he has a lot of things he wants to do. On his agenda, there is deregulation, reducing illegal immigration, trying to do something about tariffs or trade, repeal and replace the Obamacare. He wants to increase infrastructure spending. He wants to increase defense spending. He wants to cut personal taxes. He wants to cut corporate taxes. The main point I would make about all of this is people need to realize, both in the United States and around the world, the obstacles he faces, the difficulty in doing this. First problem is politics. This is the House of Representatives, the Senate, and some opinion polls. Let me start with the House. The Republicans have got a majority in the House. So what? The problem is that within the Republican Party in the House, it is very fractured. I don't understand Italian politics, so somebody told me that was like the Democratic Party in Italy right now. I don't know, is that true? But it's in the Republican Party, it's very fractured. And to get moderates to vote for something, the Freedom Caucus, which is more ideological, won't vote for it. If you can get all of them to vote for it, the moderates won't vote for it. And that's why they could not get a replacement to Obamacare through. In the Senate, there are 100 seats in the US Senate. The Republicans have got 52 seats. But there are some relatively moderate Republicans. For a lot of legislation, you need 60 votes to avoid what's called a filibuster. Now, let me clarify something. The filibuster is not in the US Constitution. It is just by custom. A majority of the Senate can vote to get rid of the filibuster on everything except for treaties and one other issue. But as a practical matter, people in the Senate like tradition. And so I don't believe that moderate Republicans in the Senate will vote to get rid of the filibuster unless it is for something that seems pretty mainstream. They're not going to get rid of the filibuster to pass a radical agenda. Those are two problems he faces. A third problem is just popularity. Look at this. At the end of March, in George W. Bush's first term, he had a 53% approval rating. At the end of March, in Barack Obama's first term, he had 61%. Donald Trump, 39%. It makes a difference. Because if the president calls you up and says, I need your vote, to a senator or a member of the House, if he's 60%, you say, oh, sure, I'll give you my vote, because you don't want to be against him. You want him campaigning for you. But if he's unpopular, then it's much easier for a Republican to say, no, I'm not going to go with you on this one. And so I think politics makes this difficult for Donald Trump. A second thing that makes it difficult is the budget. America cannot afford stimulus. Out of money. If you look at, these are forecasts from the Congressional Budget Office, CBO. Under current policy, with no stimulus, the deficit will go from 2.9% of GDP today to 5% of GDP by 2027. The debt will go from 78% of GDP today to 89% of GDP in 2027. Even without stimulus, you can't, the debt is going to get worse. And this is important because remember I talked about the ideologues, the Freedom Caucus, they won't want to push up that deficit. That makes these stimulus proposals difficult. But the biggest problem that the president faces, that America faces, is this chart here. This is my Halloween chart. This is the chart to scare people with. On the right-hand side, we show 60 years of US economic growth, 6 decades. For the first 5 decades, the US economy grew by 3.3% per year. Half came from more workers, and half came from more output per worker. In the last 10 years, it's just been 1.3%. And that, by the way, is from cyclical peak to cyclical peak. It's from a day when we had 4.5% unemployment in 2007 to a day when we have 4.5% unemployment in 2017. We only did 1.3% growth. What's the problem? 2 problems. First of all, we don't have enough workers. Look at this. These are Census Bureau projections for the American population, or the working age population, population age 16 to 64. The baby boom started in a big way in 1947 in America. The number of babies born grew from less than 3 million per year in 1945 to over 4 million in 1947. 65 years later, the number of people turning 65 jumped by 33% in 2 years, between 2010 and 2012. Those baby boomers are retiring in huge numbers, and that's what's giving us our demographic problem. Ironically, we took a look at it, and if you break it down into people who were born in the United States and people who immigrated, in the next 10 years, the working age population will grow by just 0.3% per year. It's very slow, but 85% of that growth will come from people who were not born in the United States. Without legal immigration, America can't grow. The second problem is productivity. Productivity has fallen, it's a complex issue. But one of the biggest reasons is this. One of the things that pushes up productivity is if you give workers more tools, better equipment, newer equipment to work with. That's called the capital stock. Over time, because of low investment spending, the growth in the capital stock has fallen. That is why productivity growth is so slow. And last year, the capital stock grew by just 1.6%. I'll tell you the problem with that. The number of people working grew by 1.7%. In other words, the tools per worker, the equipment per worker actually fell last year. You can't fix productivity unless you fix that. And the reason this is so important is if we are at full employment, and if the economy only grew by 1.3%, unless you can fix immigration to have more immigrants, unless you can fix capital spending to have a big increase in investment spending, very big, you can't get to 3% growth. You will have a hard time getting to 2% growth. You know, you can put a tortoise on steroids, but it won't end well. And that is what I think, that is the biggest obstacle he faces. People think there's a lack of demand. There isn't a lack of demand, there's a lack of supply. So where does this leave us with Mr. Trump's agenda? First of all, on deregulation. As a president, he has got a lot of power to do deregulation. I think he will. And he has done deregulation on energy, on environmental concerns. He will do some financial deregulation. Maybe that helps investment spending. Maybe it doesn't. For example, he says he wants to have more coal-powered power plants in America. I don't like the idea of coal-powered plants. It doesn't seem to make sense. But anyway, forget about that. The problem is if you can deregulate easily, you can also re-regulate easy. Am I going to build a power plant in America, an electricity plant using coal today? Am I going to plan to do that if I know in 4 years a Democrat could be in the White House and says it's illegal? You know, you need a permanent change in regulation if you're going to change behavior in a permanent way. So you may get a little bit of growth, but not so much. I think reducing illegal immigration by building a wall, I don't think the wall will work, but I think the attitude will work to some extent. I think you will see less illegal immigration. If we see less legal immigration, though, we've got a bigger problem. On trade, I'll come to that in a minute. On the Affordable Care Act, eventually they may replace it, but if they replace it, they will replace it with a twin. There is no way around this. Americans don't understand what they really want with healthcare, but they know they don't like anything that reduces benefits or reduces the availability of healthcare. And so I think you'll end up with something very like the Affordable Health Care Act anyway. More infrastructure spending, yes, I think we'll get more infrastructure spending because Democrats like infrastructure spending too. More defense spending, yes, I think you'll get more defense spending because that's the price Democrats will pay for the more infrastructure spending. More personal tax cuts, yeah, you get some more personal tax cuts, a little. It has to be focused on the middle class to do it. For Democratic votes, and you won't get all the Freedom Caucus votes for it. But I think you'll get some personal tax cuts. Corporate tax cuts, well, you know, by now I've spent a lot of money. I think there will be very little money left over. I will make this prediction. I don't believe the corporate income tax cut will come with a cash flow tax with border adjustments. American business hates the idea of border adjustments because it makes winners, it makes losers. And the losers always make a lot more noise than the winners. So I don't think that'll happen. I think you will get a small amount of stimulus from all of this, but much smaller than he talked about on the campaign trail. So I think that's where we're headed here. But of course, that's not the only thing. I want to talk a little bit about trade here. The president talked a lot about, I'm going to put a 35% tariff on China. I'm going to put a huge import tax on Mexico. We're going to do something about Europe or Japan. That's what he said. And he can do some things. He pulled the US out of TPP. He's trying to renegotiate NAFTA. But will he do big tariffs? No. Because think about what it means when you are face-to-face. If you're Donald Trump, you are face-to-face with Xi Jinping. You want to say, I'm going to put a 35% tariff on China. What's he going to say? Xi Jinping is going to say, well, we're going to put a 35% tariff on you, and we own $1 trillion of US Treasury bonds, which we're going to sell on the market and push up your interest rates. And don't you need our help on North Korea? Well, we'll see about that. He's got too much to lose. With Japan, Japan is the United States' most important ally in the Pacific. Do we really want to get in a trade war with Japan? With Europe, do we want to get into a trade war with Europe? Business people in America will not want that to happen. He may try, some people in the Republican Party will talk about the cash flow tax with border adjustments, but I don't think that's going anywhere either. I do think, though, one implication of this is, what's he going to do about trade? If he can't do his cash flow tax and he can't do tariffs, what's he going to do? One thing he could do is try to talk the dollar down. The dollar is important for all of your investments. I want to say a few things about the dollar. First of all, I don't know where the dollar is going to go in the short run, but nobody else does either. Everybody says that when the Federal Reserve raises interest rates, the dollar's got to go up. There is zero statistical evidence to show that's true. It is highly unstable, the relationship. But in the long run, I do think the dollar is going to come down. I think it's going to come down for three reasons. First of all, as I said, the US economy is going to grow more slowly. Europe will beat the US over the next 5 years in growth because the US is out of workers. I think emerging markets will easily beat the US in growth over the next 5 years because they have more natural productivity growth. And when the rest of the world is growing faster, money ought to go there. A second issue is our trade deficit. The US is running a big trade deficit, about 2.4% of GDP, and it will actually go up in the first quarter. Or the current account trade deficit will. That trade deficit floods the world with dollars. Over time, a trade deficit should push your currency down. But the third really important thing is this. If Donald Trump cannot achieve what he wants to on trade through tariffs, if he cannot achieve what he wants to achieve on trade through the corporate tax, he could try to do it through the dollar. Donald Trump and many of his cabinet members have said, oh, the euro's too low, the renminbi's too low, the yen's too low. At some point, they will say, wait, the whole problem is the dollar's too high, and they will try to talk it down. We've seen signs of that already. And not just the administration. Donald Trump has to appoint somebody to replace 2 open seats in the Federal Reserve, soon to be 3. And at some stage, he has to decide whether he wants to replace Janet Yellen or not. He can stack the Federal Reserve. People think that's got everything to do with interest rates. I actually think it's got more to do with the dollar. He can put a whole pile of dollar doves in the Federal Reserve who would own euro assets, yen assets, do things to try to push the dollar down. And so in the long run, the dollar is too high. In the long run, I think the dollar will come down, and that will help a little bit with Mr. Trump's trade problem. One other thing I want to say about the dollar, if the dollar does come down, I think it will help emerging markets. Remember, people have been scared of emerging markets because tariffs, or because the Federal Reserve will raise rates too fast, or because the dollar will go up. When the dollar goes up, that usually hurts emerging markets. We don't think that's where we're headed. We don't think we'll have tariffs. We think we'll have a slow rise in interest rates. We also think that the dollar will tend to come down. And if you look at emerging markets, even relative to where we were back in 2013, you remember that the taper tantrum. The current account deficits of these countries are in better shape. I think emerging markets can handle whatever happens in interest rates a lot better. So we feel quite good about emerging markets. So what could go wrong? Well, I think we also have to think about the populist movement. A lot of people in America, in the last few months, I talked to financial advisors all over America. They're scared about investing in Europe. And the reason is, they say political change. Nobody expected Brexit. Nobody expected Trump. We've got all these elections in Europe this year. Won't the populists take over? And I say to them, yeah, but look at the polls. And they say, polls. The polls are always wrong. You know what? The polls aren't wrong. The commentators are wrong. If you look at Brexit, if you look at a poll of polls, the night before Brexit, they were basically tied. Now, in the end, the Leave campaign won by 4 votes, so that is a mistake of 4 percentage points. In the US election, the poll of polls the night before the election showed Hillary Clinton with a 3.8% lead in the popular vote. She won the popular vote by 2.1%. That's a 1.8% percentage point miss. And these are mistakes, and I think the polls do undercount the populist vote. But for example, in the French election, if it is Marine Le Pen and Emmanuel Macron, Macron has got a 20-point lead in an election that's less than a month away. Do I really think Marine Le Pen is going to be the next French president? No. Do I think Alternative auf Deutschland is going to be the next German government? No. Italy, I spent 2 days trying to understand Italian politics. I don't understand it yet. I do think that the risk in Italy is somewhat higher of a more unstable outcome whenever Italy does have an election. But let me say one more thing. What are we scared about in Europe? What we're scared about is that countries will pull out of the euro. Who's going to pull out of the euro? The Greeks didn't pull out of the euro, and they had every reason to. The problem is, how do you do this? If the French decide to pull out of the euro and launch a new franc, what would happen? The franc would sink to the bottom of the Atlantic. If the Italians, and excuse me for saying this, launched a new lira, what do you think would happen to the lira, given the amount of Italian debt? You know, Britain could leave the European Union because it wasn't a member of the single currency. Leaving a trade union is a quantum leap easier than leaving a currency union. It's like the difference between divorce and divorce with kids. It is just a lot messier, and I think in the end, the euro is here to stay. And I think when people see this, the political fears will die down. But that doesn't mean I'm not scared of some things. Interesting picture here. I'm not going to talk about who is the craziest of them all. What I will say is all these people are people who regard themselves as strong nationalistic leaders. And when strong nationalistic leaders butt heads with populist movements, it can cause problems. And so people need to be diversified. But that is always the case. People need to be diversified. Let me finally talk a little bit, and I want to leave time for questions, but talk a little bit about what we think this means for investing, particularly in the United States. First of all, we think there is still some opportunity in US stocks, but less than there was. This chart here looks at PE ratios going back for the last 25 years. And this is a forward PE ratio. And as of the end of March, we were at 17.5 times, about 10% above average levels. And because we think earnings will grow slowly, that limits the growth in the US stock market over the next few years. But within the US stock market, we think interest rates will go up. Right now, interest rates are still very low. I think the bond market is misinterpreting what the Fed's going to do. If the Fed keeps relentlessly raising short-term rates, long-term rates will go up also. They always do. And if you look at what this shows is the correlation between different sectors within the US equity market and the 10-year Treasury bond. You want to be overweight the cyclicals, things like financials, consumer discretionary, materials, industrials, and underweight things like REITs and utilities, which people are buying for the yield. Because things which are long duration with a high yield, those are the most vulnerable things when the Fed raises rates. You have to be active and thoughtful within the US market. Within the US bond market, at the end of March, we were at 2.4% on a 10-year Treasury. This afternoon, we're at 2.3%. I know rates have backed up some. They will back up more. Historically, the real 10-year Treasury yield over the last 60 years, you see in the box here, the real Treasury yield has been 2.4%. Today, it is basically zero. I mean, it's at the end of March, it was was 2% or 0.2%, now it's 0.1%. That's too low, and over time it will go up. So within fixed income, it's going to be tough. Again, what we show in this chart here is, well, where can you make money in fixed income when rates are rising? What we show is the impact of a uniform 1% increase in rates. And what we show is that floating rate bonds or notes, because they're short duration, high yields and convertibles tend to outperform. Again, people need to be thoughtful, active when it comes to investing in US equities. And I should say that over time, we also see a lot of opportunity in international equities because the rest of the world has got more room to grow from this point than the US. So where does this leave us in terms of the outlook? First of all, we expect slow, stable growth, not too much inflation, but we think the tortoise will continue to grow slowly. Second, we expect only a small amount of the Trump agenda to be implemented, and that will not change the basic 2% growth rate of the US economy. Third, we don't expect big tariffs, and we don't expect a problem from a rising dollar. We think, in fact, in the long run, the dollar will come down. Fourth, we do realize that, when you see Syria, North Korea, the US, when you see geopolitical problems, it does mean volatility. People need to be prepared for volatility, and these nationalist leaders clashing will cause volatility. And then finally, I think it's important for people to invest in a diversified way, but also recognize that cash is paying you nothing. I don't believe that central banks have been effective in stimulating economies. I don't think negative interest rates work. I don't think zero interest rates work. I think they slow the economy down. Central banks have not fixed the global economy. But they have fixed it that you cannot make money through saving, you can only make money through investing. When rates are this low, I still think people should be in stocks around the world. Essentially, there are three piles of cash in the world, three piles of liquid assets. There's stocks, there's bonds, there's cash. If cash is paying you nothing, and bonds are paying you almost nothing with a certain amount of risk, I think money will still tend to flow to stocks. And the last thing I would say is this. Overall, I think the investment outlook is reasonably good for the world. I think the investment outlook is reasonably good for the United States. I understand there will be political tensions, but I think people should invest based on an analysis of the economy, not on politics. One of the most important rules in the United States over the years has been, don't let how you feel about politics overrule how you think about investing. I think that is still true today. People should not allow how they feel about politics, no matter how strongly they feel about politics, they should not let how they feel about politics overrule how they think about investing. Thank you.
Grazie David. Sì, abbiamo tempo per qualche domanda. Volevo solo ricordare che questa presentazione vi verrà inviata nei prossimi giorni a ognuno di voi che è stato qua con noi. Gran parte delle slide che avete visto sono state tratte dalla nostra guida ai mercati, un documento che voi o molti di voi conoscono e quindi e che David Kelly, diciamo, ha inventato qualche anno fa, quindi onore al merito. Grazie ancora David per la tua ingegnosità. Niente, se ci sono domande partiamo subito, non so quanti minuti abbiamo. Sì, perfetto, scusami, via.
Can I do?
Domande, lo dico solo, domande su strategie di mercati, non su prodotti, perché giustamente Kelly, essendo strategist di prodotti, non ne sa granché.
Okay, I can make the question in English, so maybe it's more direct.
Forse è meglio che fai in italiano per gli altri, così almeno tanto lui sente. Fallo in italiano che gliela traducono, grazie.
Okay. Allora, se posso avrei 3 domande, non so, poi al limite scegliete. Dunque, lei ha detto il dollaro troppo alto. In in mia opinione, molti analisti ritengono che nel lungo termine un cambio di equilibrio potrebbe essere intorno a 1,20 con l'euro. Volevo sapere cosa ne pensa. Questa è la prima domanda.
Okay.
Sul debito pubblico americano, io ho visto cifre intorno al 100% del PIL oggi. Lei invece ha mostrato meno di 80%. Non so, ho dei dati sbagliati io o l'ho calcolato in modo diverso? E cosa ritiene sia un debito sostenibile e cosa invece sia qualcosa di rischioso? Dato che il dollaro, essendo una valuta di riserva, comunque permette agli Stati Uniti di indebitarsi molto di più di tanti altri paesi. E poi, vabbè, in realtà qui l'aveva già toccato il discorso sul livello del mercato azionario degli Stati Uniti. Se sopravvalutato o no, può elaborare un po' di più, ha commentato velocemente sul price earning al 17, eccetera. Grazie.
All right. Okay, well, that is 4 questions. I will try and remember them. First of all, on the dollar, yes, I think 120 is probably a good value. In fact, 120 is the average value of the US dollar-euro exchange rate since the euro came into place almost 20 years ago. But yes, I think that is a reasonable number. The US is running a big trade deficit. The Eurozone is running a trade surplus. I think a number like that would be closer to balance, and that is important. Second, with regard to the debt, I'm using the debt in the hands of the public. The overall debt of the United States is about $20 trillion, the debt of the federal government. But about $5 trillion or $4.5 trillion of that is money the federal government owes to the Social Security Trust Fund within the federal government. The money that is important is the money the government has to borrow from somebody other than the federal government, including, by the way, the Federal Reserve. So that is debt in the hands of the public. And most economists, and the CBO, the Congressional Budget Office, look at debt in the hands of the public. With regard to a sustainable number, I don't believe there is any magic rule at all for this. I know that there are, Rocard and Reinhoff talked about some level, some magic level, which gets you into trouble. I think that's nonsense. I don't think there's anything reliable at all. What I will say is that a growing debt limits your options. First of all, the first thing I'd say is, so long as your taxes aren't that high, the real question is, well, what's the debt that you could actually tax out of the American economy to pay back? And that's a very high number. It's higher than this, particularly if you can keep interest rates low. But I think the real problem is that when the US hits a recession, then the debt is going to jump again. There is an old saying in the Bible that you have 7 years of plenty and 7 years of famine, and you're supposed to make provision. These are the 7 years of plenty. We should be making provision. And then the fourth question was about? Oh yes, the US equity market. Yes, we always tell our clients that past performance is not indicative of future returns, but we all know that it is worse than that. Past performance hurts future returns. On a cigarette package, you get a warning about this is bad for your health. On the investor cigarette package, it should say past performance can hurt future returns. That, I think, is the truth with the US. So, we are about 10% above average PE ratios. Suppose in 5 years, we are at average PE ratios. That will take 2% per year out of your total return. Now, on earnings, we believe earnings should grow about the pace of nominal GDP, so we'll say 5% per year. But if earnings grow at 5% per year, and the PE ratio comes down, then stock prices will only go up 3% per year. You can add on 2% for the dividend yield, so you're back to a 5% total return. But I think that is a reasonable expectation for US stocks going forward, about 5%. We could have a correction, we probably will have a correction along the way, but then it will bounce back. But I think the important thing is, over the past 25, 30 years, people have been used to a much higher return than that, and that's just not realistic going forward. I think something like 5% over the next 5 years in total return. And that's why you have to use active management, favor cyclicals over defensives and so forth to try and enhance that return. And sorry, there's one last thing I want to say about that. Also, we are seeing very low correlations within the US stock market right now, so it suggests that there is more opportunity for stock pickers to take advantage of cheap stocks than there used to be. Yes.
Abbiamo credo un'altra domanda, ho 4 minuti, se qualcuno lo vuole fare, sì, vedo un microfono lì al centro. 2 addirittura. Se facciamo velocissimo, grazie, ce la facciamo. 4 minuti.
Lo tengo il microfono,
4
perché
minutes.
se no non facciamo la domanda.
4 minutes, prego.
Giorno?
Sì, qua davanti, sì.
Mr. Kelly, thank you very much for your speeches, the first time. But I have a question now.
In italiano.
In Italian, ok.
In italiano. Grazie.
Noi assistiamo a una situazione di Mr. Trump come se fosse il Dr. Jekyll di giorno e Mr. Hyde di sera, di notte. Quindi ci troviamo adesso nelle condizioni di cercare di capire quale probabilità può essere per mettere una border tax, come diceva prima, come giustamente lei ha detto prima, una border tax non sulla Cina, perché sulla Cina ci sono troppi legami economici, ma su qualche prodotto europeo. Questo sarebbe molto importante per l'Europa. Noi siamo in Europa e dobbiamo vivere l'Europa come una cosa vitale per noi. Grazie, Mr. Kelly.
Okay. We have not decided in the United States whether he is Dr. Jekyll or Mr. Hyde, and maybe like Dr. Jekyll, he changes in an unpredictable manner. But the important point is the US political system will likely constrain what he can do. Even when it comes to certain products that the US would import from Europe, there will be business leaders in the United States who will lobby very hard to make sure that they don't get hurt by this. So I believe that's the first thing. I think that will be a political barrier to him doing anything that would be in violation of WTO rules. The second thing is that I am sure that the Europeans will respond in kind. I think that, and they should. And so when Americans feel the bite of Europeans saying, well, if you do this, we're going to do that, you could have a short trade war and then it would end by, okay, you take down your tariffs, we take down ours. So I really think the system will prevent him from I'm not sure what sort of a dog, whether he's a big dog or a small dog, but he has a muzzle on in the political system, and I think that's what we will see.
L'ultima domanda, 1 minuto e mezzo, grazie.
Yes.
Buongiorno. Il debito pubblico americano, così come il debito pubblico delle principali economie avanzate, è in continuo aumento e questo fa il paio con l'aumento dell'età della popolazione, l'invecchiamento della popolazione. Questo porta sostanzialmente a un contenimento dei tassi per quanto riguarda di crescita e anche ovviamente i tassi obbligazionari. La domanda provocatoria forse, sarà possibile mai trovare un 4% ancorché a lungo termine di un'emissione obbligazionaria? Grazie.
The short answer is yes, but be careful what you wish for. First of all, more debt doesn't hold rates down. More debt tends to push rates up. At some stage, the US economy and the European economy will be at full employment. If you push past that, then you have inflation. Inflation will tend to push up long-term bond yields. And even if central banks buy those bonds, after a while, you still need some private sector buying, and I think those rates will go up. So I'm worried that that could happen. With regard to the size of the public debt in Europe or in the United States and aging, yes, we're all living longer, so we should all have to work longer. There is a political solution to this, which is simply to index the age of entitlement to retirement benefits to to life expectancy. And I think in time, all developed countries will have to do this. There are solutions, but the short answer is yes. I think that in time, when these economies hit full employment and central banks get scared of inflation, then you will see higher rates. And I worry that if we're in this room 5 years from now, you will wish that rates were just down at 4% and not much higher.
Grazie mille David, grazie per la tua presentazione, buona continuazione a voi tutti. Grazie.
Thank you very much. Thank you.